I think for the alternative lenders, it'll continue to be a very good market. Australia has a relatively, it's very much dominated by the banks. So the banks in Australia control about, approximately 90% of all commercial real estate debt in Australia. And that's a very different number to what you find in the US and Europe, where the banks tend to be 40 to 50%, and then you have a lot of alternative financiers that pick up the rest. So a lot of the alternative market is very much, in Australia, very much dictated by what the behaviour of the banks are and where their appetite is. And I can't speak firsthand for a bank, but I would say as an external observation, it appears that the banks are more inward focused, less looking to do less things, more focused on absolute prime borrowers at this point of time. So I think that what that will do is say there's just more demand for alternative lenders, and I think that the conditions that we've seen over the last 6 months in particular, we should expect to continue over the next 6 to 12 months. I also think that if you look at foreign lenders who have been a big part of the market over the last 1 to 2 years, and the opportunities that they're facing in home markets such as Europe and the US, we should expect them to also be more focused on their home markets relative to Australia. So again, the local players such as Qualitas, I think should have a reasonable amount of market share over the next 6 to 12 months. I was reminded recently of probably the 101 of lending that I was taught a very long time ago. In fact, one of my first roles was working in a Japanese bank in the 1980s. And as you can imagine, it's exceedingly regimented and tight as to how one thinks about it. And there was 3 fundamental things that you learnt back then. And the first one is that when you give somebody a loan, think about what your primary exit of the actual loan is. So if you're doing a development loan, that might be in the area of the sale of apartments is my primary exit, because when those apartments settle, they'll repay my loan. The second thing is think about your secondary exit. Well, the secondary exit would normally be a refinancing point. Somebody else, another lender in the market, might seek to refinance us. And then think about your tertiary exit. And your tertiary exit would be an unfortunate situation where I might need to exercise on my security in the unlikely event that that's the only way I've now got out of my loan. And so I was reminded of primary, secondary and tertiary, how fundamental that is to maintaining asset quality. And so I think that that's a good takeaway from the whole COVID experience. Don't forget primary, secondary and tertiary exit points. The other thing I would say is it's not just about what a lender learns as you go through these experiences, but I think it's also about what the borrower learns as well. And one of my observations is that the borrowers themselves have become more educated and more discerning in terms of understanding who their lenders are. So perhaps pre-COVID, there was less differentiation between lenders. And in fact, if you had money and you could write a check, it was seen to be a relatively homogenous product. Money's money. But I think when you go through these periods, borrowers have worked out that lenders have different sources of capital, different ownership of capital, and they speak differently for the capital. And so what we have found is that a lot of the borrowers are looking for lenders who control the capital that they speak for, and they've just become more discerning, looking for greater levels of certainty. And so that's been an interesting observation as well.